Now, welcome to our today's class, that is Fundamentals of Finance. And in our today's class, we're going to talk about the working capital management. Sawa. Now, when we talk about the working capital, generally, working capital is just the current assets minus current what? Liabilities. Are we together? Now, in our case, we want to know how a company can manage what? Capital. So what we mean when we talk about the working capital management, in this case, they are just the administration and policy guidelines by the company on current assets and liabilities. Are we together? And we have the importances of this. Why is it important for an organization to maintain the working capital? Number one, we know the working capital in this case represents the largest proportion of the company's what? Assets. Are we together? This is where we have in the current assets. This is where we have in the current assets, like the inventory. We have the cash. We have also the receivables. And remember, in that case, that is what makes an organization to work. And that's why it is important for them to manage what? The working capital. Same case also, the working capital items, or generally the current assets, represents the largest proportion of the sales volumes. When we talk about the sales volume, in this case, we are talking about the account receivables. Kuna debtors. Are we together? So in that case, on the debtors, remember, in that case, the debtors here is also another area where we are having a lot of frauds. Are we together? And since we have a lot of frauds generally on ledgers, on the debtors, whereby you find that there are bad debts that have been written off. Ama upate customer alilipa na haijarekodiwa kama alilipa. Sindio? In that case, that is also another thing that we make you to maintain the what? Working capital. So we'll also be able to give the notes on the same. Now, there is what we call the working capital financing policies. Working capital financing policies. Working capital financing policies. Working capital financing policies. Now, when you talk about the working capital financing policies, this is how an organization finances its working capital items. Are we together? And an organization finances its working capital item using three methods. We have what we call the aggressive financing policy. Number two, we have what we call the conservative financing policy. And number three, we have what we call the what? Moderate, or in other cases, we call it the what? Martin financing what? Policy. Now, in this case, working capital is categorized into two. There is what we call the permanent working capital, and there is what we call the seasonal working capital. When we talk about the permanent working capital, kama ni yenye imerealiziwa on the first year, the working capital, it will be maintained at the same level up to the end of the year. So kama ilikuwa January 45, that was what was realized. Ikumaanisha itaenda hivyo mpaka the end of the what? The end of the year. That is what we call the permanent working capital. Then we have the seasonal working capital, and the seasonal working capital is the one that we keep on varying. Haitakuwa the same. So in this case, under the aggressive financing policy, both the permanent working capital and seasonal working capital, they are financed using the short-term sources of finance. And the reasons why they are financed using the short-term sources of finance, because short-term sources of finance are cheaper. Are we together? And which are these short-term sources of finance? We are talking about the trade creditors. We are talking about the bank overdraft, the accruals. Are we together? They are very cheaper as compared to the long-term sources of finance. And that is under that policy. whereby the working capital items are financed using the short-term sources of finance, and that's generally for the permanent and the seasonal working capital. Tuko pamoja? Then number 2, we have what we call the conservative financing policy. Conservative financing policy is whereby the working capital item, that is both the permanent and also the seasonal, are financed using the long-term sources of finance. Are we together? And why are they financed using the long-term sources of finance? Because in this case, for the long-term sources of finance, they are not risky. You can still have that money and invest on it. And that is why in that case, the conservative financing policy is used, or it is the working capital items are financed using the what? The long-term sources of finance. Now the last one is now the moderate or the matching policy. Moderate or the matching policy, this is whereby the permanent working capital is financed using the long-term sources, while the seasonal working capital, in this case, is financed using the what? The seasonal working capital in this case is financed using the short-term what? Short-term sources of finance. Are we together? And that is how, in that case, you need to be aware. So in that regard, we can have an example on the same. Can have an example on the same. Can have an example on the same. You write, just write this one. Just write this one. Say Maua Horticultural, right? Maua Horticultural Limited runs a flower export business. Maua Horticultural business runs a flower export business. The company has two sources of funds at different interest rates. Company has two sources of funds at different interest rates. At different interest rates. Different interest rates. Say the finance cost of the short-term funds. The finance cost of the short-term funds is 20%. Is 20%. While the cost of the long-term funds, is 25%. Is 25%. 25%. These costs are expected to remain constant in the next 2 years. These costs are required to remain constant in the next 2 years. See, the projected monthly working capital requirement, the projected monthly working capital requirement is as follows. The projected monthly working capital requirement is as follows. We have the month, and in this case, we have the what? Working capital required. Working capital required. The working capital required. We have January, February, March, April, May, June, July, August, September, October, November, and we have what? December. So for the January, in this case, is shillings in thousands here. 35,000. 35,000. The other one is 52,500. 52,500. This one is 70. This one is 105,000. 105,000. The June is 157. 157,500. Then we have the other one is 210. 210,000, 242,500, 157,500, 157,500, 87,500, 70,000, and then we have 52,500, 52,500, 52,500. You are required the average monthly permanent required, the average monthly permanent, and seasonal working capital, the average monthly and permanent, and the permanent, the average monthly permanent and seasonal working capital requirements, and the seasonal working capital requirement for the month. And then number 2, the total cost of working capital finance, the total cost of working capital finance for the company, the total cost of working capital finance for the company using Roman 1, the aggressive financing policy, and Roman number 2, the conservative financing policy, and Roman number 3, is the moderate financing policy, Now, from the first one, in this case, from the first Roman 1, you are required to look for the average monthly permanent and seasonal working capital. So I said on permanent working capital, this is what we mean. If in this case, the working capital that is required on the first month is 35, ni kumaanisha the whole of the year, each and every month, the permanent working capital itakuwa nini? The company will be requiring a permanent working capital of 35,000. Are we together? So in that case, for the permanent will be 35,000, 35,000, 35,000, 35,000, 35,000, 35,000, 35,000, 35,000, and also 35 what? 1,000, 35,000, and then we have 35,000, and then 35,000. So in that case, that is what we have in S, the permanent working capital. So are we together? Now, for the permanent working capital, in that case, you can just take 35,000, you multiply by 12, ndio ujue the total. Itakupea ngapi? In 12 months, 420. That is for the permanent. Now, for the seasonal working capital, the working capital will keep on what? The working capital required, it keep on changes. Sawa. And in that case, for you to get that, you just take the working capital required, you minus the permanent what? Working capital. Sawa. So in first month is 0, the second month is 0. So 52,500 you minus 35,000. Inakupea ngapi? Yes? 17,500. 17,500. 17,500. So 70,000 minus 35, it will also give you what? 35,000. 105 minus 35, 70,000. Then 157,500 minus 35 will be equal to how much? 100 and what? 120? 500, sindio? Or 122, 500. Is it 122, 500? 122, 500. To 10 minus 35. 175,000. 242, 500 minus 35. Nakupea ngapi? 2 or what? 500. And then the other one is 157, 500 minus 35,000. In that case, itakupea 122 what? 587, 500 minus 35,000. Inakupea ngapi? 52, 500. And then the other one is 35,000. And then 17. So get the total for us to know the total. What is the total for the seasonal working capital? Or the total for the seasonal working capital? Is given you how much? Yes? You get in how much? 8,000. You got in how much? 855,000. Yes, it's supposed to be 855. 855,000. And that is for the seasonal working capital. So in our Roman number 1, we were required to look for the what? That is A. You are required to look for the average seasonal and permanent working capital. So for the permanent, the average will just be 420 million. Remember, shillings were in thousand. You divide by how much? 12 months. Sindio? Which in that case, it remain 35 million. Then we also have for the seasonal. Seasonal will also be 855,000. You divide by what? 12. Itakupea ngapi? 71,250,000. That is on the A. Now B, in this B, we add B Roman 1, where in that case you are required to determine the total cost when you use what? Which type of finance? When you use aggressive. So under the aggressive policy, we've said in this case, the working capital in this case is financed using the what? The short term. And we have the cost of the short-term funds. What was the cost of short-term funds? 20%. So in that case, you just take 20% of the total working capital, which in that case is 420. You add 420 million. You add the other one, which was 85,000 million. So in that case, what will be 20% of that? Nakupea ngapi? Yes. How much is it giving you? Yes, Christine. How much? Yeah. 255,000. 255 million. That is how it's supposed to be. When you just take 420, you multiply, you add, you umepata hivyo? Yes. Then for the conservative, we say that they are financed using the what? Long term. So conservative. So in this case, what was the cost of the long term funds? 25%. So it will also be 25% of 420 million. You add 855 million, which in that case itakupea ngapi? That case itakupea ngapi? Yes. 318. 750,000. That is for that case. Now we have Roman number 3, which is now on the what? Margin, or what we call the moderate. On the margin, we say that the permanent working capital is financed using the long-term funds, and this one for the seasonal using the short-term funds. So in that case, tuanze na permanent working capital. And a permanent working capital in this case ilikuwa ngapi? The total is what? 420 million. You multiply by the cost of long-term funds is 25%. Sindio? And then we are also saying for the seasonal is financed using the what? Short term. So in that case also, I will also have for the seasonal, which in that case it will be 855,000. You multiply by what? You also multiply by 20%. Hii ya kwanza umepata ngapi? 105,000. 105 million. So in that case is 105, and the second one 171 thousand. 171,000. If you get the total, itakupea ngapi? What is the total? Should be 276,000. So if in this case, you are required to make or to advise the company on the appropriate working capital financing policy, unaweza wa advise wachukue gani? Yes? Aggressive. Because in this case, the total cost of finance itakuwa nini? Itakuwa kidogo, 255. As compared to this other one, which this is 318 and this is 276. Are we together? Yes. Now, the other area that we also need to know, in this case, as we've said, working capital is current assets minus current liabilities. Kumaanisha the organization in this case is maintaining the working capital on the current assets where we have in the inventory, sawa, and also where we have in the what? We also have the debtors and also have the what? What we call the cash, sawa. Then we have on the current liabilities where we have the creditors and also the accruals and also bank overdraft. So we want to know, for example, on the working capital, on the management of the inventory. Now, on the management of inventory, in this case is now what we call the inventory management. And in this case is managed through what we call the economic order quantity. When we talk of economic order quantity, this is the now level at which an organization is required to make an order for particular commodities. Are we together? Where in this case, for you to get the economic order quantity is normally given by 2RS all over what? 8. And then you take the square root. Are we together? Where in that case, I'm talking on the inventory management. Don't confuse that. So in that case, R is just the annual demand annual demand, where in this case S is ordering cost per order. And then number 3, we have H, which in that case is holding cost. Holding cost. Sawa. And for the holding cost in this case, you normally get it by taking the cost, you multiply by the carrying percentage. Carrying percentage, which is represented by I. Sawa, which is normally represented by I. From your first paper, try an example on the same. From your past paper, that is the question number, May 2016 question number, May 2016 question number 3B, May 2016 question number 3C, not 3B, May 2016 question 3C. Now, being given there, Japan Limited uses 2,000 units of stock item K each year. The cost of holding a single item of a year for a year is 2 shillings, and the cost of placing an order is 45. The company is considering to double its ordering batches from 2,000 to 4,000. You are required the economic what? Order quantity. And therefore, for you to get the economic order quantity, as I've said, it will be 2RS all over what? 8. Sawa. Where R in this case is the annual demand, and per year, one has stock how many items? 2,000 items. Sawa. Then we've also been told that the holding cost, we've been given the holding cost, which is 2 shillings. The cost of holding a single item and the cost of placing an order, which in this case is the ordering cost, is of how much? 45. So in that now we can get this, which will be 2, you multiply by 2,000, multiply by 45, then you divide by 2, and you take the square root. How much? 300 units. That is the economic order quantity. Sawa. Then in that case also again, Roman number 2, you are required to get the number of orders. The number of orders. So if in this case, every order they make, they have to make 3,000 orders. What I make how many orders for the whole world? Yeah, which is on the annual demand. Sawa. Which normally is given by the annual demand, you divide by what? The economic order quantity. Sawa. So in that case, the annual demand is 2,000. You divide by 300, which in that case, itakupea ngapi? Yes? 6.67, which in that case you can say is just 6 what? Hakuna venye unaweza make have an order. Sawa. Lazima ikuwe complete order. Then Roman number 3, you are required the number of days before an order is being placed. So the number of days before an order is being placed, in this case, we know the orders that will be made in a year. And the days that we are having is how many days? So in that case, for you to get the number of days, you just take the number of days in a year, you divide by the what? The orders that are made in the what? In that year. So itakuwa ngapi? How many days? Yes? 60.3. That is 60 days. So after every 60 days, in this case, an appraiser what? An order. 60 days in that case. Now the other one is advise the company, the management, whether the decision to double its ordering batches could be what? undertaken. And for that decision, for you to know that, you have to determine what we call the relevant cost. And the relevant cost here, relevant cost. The relevant cost in this case is only the holding cost. Holding cost. You add the ordering cost. Ordering cost, you add the ordering what? Ordering cost. For you to get the ordering cost, is just a R, Q8. Then for the ordering cost, in this case, is R over Q multiplied by what? Where in this case, the Q is the economic order quantity. And therefore, for the economic order quantity in this case, ilikuwa 200. Ndio maana tunaambiwa hivyo. Which in that case, ulipata is how many units? 200 units. Sawa. Unaona hapo tunaambiwa they are considering doubling their what? Batches from 200 units to what? So hapa hatuta consider this one. The batches will consider ni 200 what? Batches. So in that case, it will be a half multiplied by 200. You multiply by 8 is what? 2. Sindio? Plus the other R. R in this case is the annual demand, which is 2,000. You divide by 200. You multiply by S, which is how much? S tulipata ni 45. Sawa. Hiyo ndo ya kwanza ndio ujue the total. Then ukimaliza urudi tena, the batches inapelekwa to 400. Sawa. Kumaanisha sasa kwa economic order quantity, we now replace it to 400 units. Hii inakupea ngapi? 650. That is the total cost. So and this is in 200 units. What about in 400 units? In 400 units, in this case, it'll also be a half. You multiply by 400, you multiply by 2, plus 2,000, you divide by 400, you multiply by 45. Inakupea ngapi? Inakupea ngapi? 6? Umepata 635. 25. Sawa. And I should replace, or should he, when you check on that case, you should do what? Anaweza, because unaona the cost, the total cost inateremka, sindio? Yes, and that is the decision that you are supposed to make on that case. Sawa. Now, the last area is now, before that, okay, we'll just come and continue on the same, on that area of, there is a cash management, there is also the debtors management, and also the what? We'll also talk of the account receivable, I mean the payables and the bank overdraft.